Hello, my name is Jada Shorta, and I will be talking to you today about the expansion projects and my personal suggestion. So, the sources of capital that should be included when we estimate Deary's WACC, it should be primarily the debt and equity. From there, should the component costs be figured on before or after tax regarding the basis? Stockholders are generally concerned essentially with the corporate cash flow and the accessibility for their utilization, specifically those cash flows which are accessible to deliver dividends for reinvestment. Since these dividends are paid and reinvestment is made with after-tax dollars, all cash flow and return state estimations ought to be done on an after-tax basis. Hence, the component costs be configured on a after-tax basis. Cash flows used to pay these dividends or returns to shareholders are evaluated on an after-tax basis. So the component costs should be evaluated on an after-tax basis, which is meaningful to the shareholders. Shareholders are interested in the return as they are going to receive this on the after-tax basis. Hence, it is the right way to evaluate the component cost. So, should the cost be historical costs or new costs? Because this is a new project, the marginal cost we are considering in raising the capital, it is new marginal costs. So, what is the market interest rate on Deary's debt? Interest rate is 12%, and the cost of debt is 12%. So to calculate this, it'll be 12% times 1 minus 40%, which is equivalent to 7.2%. So what is the cost in the firm's cost of preferred stock? The cost of preferred stock is 10%. This was given. The cost is calculated before tax and cost of debt after tax. Thus, the cost of debt is lower than the cost of preferred stock. Why is there a cost associated with retained earnings? The cost of retained earnings is the opportunity cost as the investors sacrifice the earnings they can earn to invest money elsewhere. So what is Deary's estimated cost of common equity using the CAPM approach? To calculate this, we take the 7% plus 1.2, multiply that by 6%, which we get 14.2. So following that, what is the estimated cost of common equity using the DCF approach? That would be 4.19 times 1 plus 0.05 divided by 50. All that plus 0.05, which is 13.8%. From there, we also have to calculate the bond yield risk premium estimated for Deary's costs of a common equity. To calculate that, we take 7.2 plus 4%, and we get 11.2%. So my final estimate for Deary's cost of common equity, we would take those three numbers, which is the 14.2, 13.8, and 11.2, and we divide all those by 3, which we get 13.12. So what is the estimated cost of newly issued common stock, considering the following costs? The estimated cost would be approximately 24.64%, considering the flotation costs. The increased cost of the new common stock compared to retained earnings is attributed to the flotation cost, which encompasses the expenses incurred by a company during the insurance of new cost. These costs diminish the available funds for the company. In contrast, the retained earnings, being funds readily accessible to the company without incurring additional expenses, have a lower cost. Issuing a new common stock, which requires the company to relinquish more than the face value of a stock to cover these incurred expenses, resulting in a higher overall cost compared to the utilization of retained earnings. So what is Deary's overall or weighted average cost of capital with WACC, assuming that they can fund the project without having to issue new stock? To calculate this, we take 30% times 4% plus the 10% times 0 plus 60% times 4, which we get 3.6. Management has agreed that the hurdles should be adjusted by 2% for higher risk projects and -2 for lower risk projects. Based on this rationale, what my suggestion would be project number 3, as this project number 3, because management wants to have a higher risk, that's not the current level, which aligns with project number 3's. Not only this, but project 3 has an expected return of 14.3% with the additional 2% for a higher risk, which would make it 16.3%, which has the highest rate of return, higher, greater than both project 1 and project 2, which makes it the most logical and favorable choice. Thank you.